The greatest killer of speculative fortunes is not the crash, not the bear market, not the clever manipulation of the insiders who try to shake you out. No, the true killer is far more insidious. It is the 3 seconds between seeing a potential opportunity and waiting for that opportunity to confirm itself upon the tape. That gap, that momentary failure of nerve, the gap of impatience. This is the market's toll booth designed specifically to extract capital from the impulsive, the quick hand, the nervous entry, the eager fool. If you cannot master the discipline of waiting for absolute proof, the market will treat you like a common gambler and you will lose everything you possess. But here is what makes this even more critical than you probably realize right now. You must understand this truth immediately. The impulse to trade is a destructive instinct. The disciplined waiting for the signal is the highest form of professional speculation. In UK, subscribe now, like this video, and leave a comment. By doing that, you help more people see this message and you let me know this work is not in vain. The immediate impulsive urge to get in now is the market's oldest, most reliably fatal trap. It springs from the twin fears, the fear of missing out on the first tick and the fear that the price will run away from you before you establish your position. This impulse is an emotional reflex. It has no place in speculation. The danger of trading on impulse is simple. You are acting on hope, not evidence. You are betting that your personal assessment, your prejudgment, will override the factual movements of the general market. This is a disastrous conceit. The professional operator waits. He watches, he confirms. The amateur rushes. He hopes. He buys on the rumor of a move. The most common error witnessed day after day, year after year, is the failure to wait for the crucial confirmation point. The speculator sees a stock turn up 2 points. The impulse shouts, "Buy now. If you wait, you will pay more." And so the impulsive trader rushes in. He buys immediately, saving perhaps a half point or a full point on the entry price. He feels clever. He feels fast. But what happens next? And this is where it gets dangerous. That half point saved on an early entry often costs 50 points later. How? Because an impulsive entry is inevitably a poorly positioned entry. When you enter too soon, you do not have a confirmed line of least resistance. You have only an expectation. The stock often pulls back to test the very level you just rushed past. The fluctuation that follows the premature entry causes immediate distress. The capital is now held captive in a nervous position. The speculator is immediately placed on the defensive. Forced to watch the tape with anxiety, calculating whether he must violate his own rule and cut the position before the major move he anticipated has even begun. He becomes emotionally invested immediately. The position is small, but the stress is immense. He has ruined his clear judgment. A professional entry is made when the market has proved its willingness to move in the desired direction. A professional entry allows for a much tighter, more logical stop loss, because the risk has already been partially mitigated by the market's initial action. An impulsive entry based on a hunch requires a wider stop. Why? Because the market has not yet decided its path. You are exposed to the maximum amount of fluctuation. If you save 1 point by rushing in early, you often risk 10 points just to survive the initial unnecessary shakeout. That one saved point is a false economy. It is the cost of impatience. But most traders never learn this lesson. The operator who waits, who pays the slight premium for confirmation, enters the market with clarity. He knows exactly why he is there. He has proof. He buys the stock after it confirms the break, not before it breaks. This patience allows him to sleep at night. It maintains his mental clarity. He is trading on evidence, and the market's inevitable fluctuations, though annoying, do not threaten his confidence or his position because he knows the primary signal remains intact. Impulse destroys judgment. It shifts your focus from what is the market doing to what is this stock doing to me. Never allow the urge to save a minor fraction on the entry price to dictate your timing. Time is infinitely more valuable than a few ticks. Wait until the market gives you permission to proceed. You must learn to distinguish between a hunch and a signal. They feel similar to the untrained speculator, but their origins and consequences are worlds apart. A hunch is rooted in desire. It is based on the emotional dread of missing the coming movement. It is often triggered by gossip or a momentary sharp spike on the tape that catches your eye. A hunch is fundamentally subjective. It is the hope that you are smarter than the entire market and that you can predict its immediate future. A hunch is usually a justification for risk. A signal is the opposite. A signal is concrete. It is derived entirely from market action, from the indisputable behavior of the price and volume around critical points. A signal is objective proof. And this distinction changes everything. The greatest speculators learned early in their careers that they rarely traded on the first interpretation of events. Initial analysis might suggest a certain course, but they always waited for the market itself to affirm that analysis. The market has a way of showing its hand, but only after it has tested the patience of the crowd. A genuine signal is the unambiguous proof of the line of least resistance. It is the moment when the market has clearly stated that it requires less effort to continue in one direction than to reverse. A hunch is merely an emotional justification to risk capital immediately. Consider a stock that has been accumulating for weeks within a tight range. You, having studied your charts, believe it is about to break upward. The price begins to rise slightly, touching the top of the range. The hunch says this is it. By the moment it touches the high, the signal demands patience. The signal requires not just the touch of the high, but the clear, sustained penetration of that high. It demands that the price holds above that resistance, confirming that the forces of buying are overwhelming the forces of selling at that crucial point. Until that happens, the initial spike is merely a transient fluctuation, a probing action. It is designed to trap the impulsive buyer and allow the experienced operator to unload paper into nervous hands. The hunch invites you to buy the probe. The signal invites you to buy the established breakthrough. A true signal requires time and clarity. It must be repeatable evidence. It must demonstrate institutional support or overwhelming public sentiment. It cannot be fleeting. If you are acting based on a gut feeling, a whispering voice, or a tip you overheard, you are operating on a hunch. If you are acting because the price has closed above the confirmed resistance line on heavy volume and held that position for a sustained period, you are acting on a signal. The difference determines whether you are a gambler or a professional speculator. One relies on luck. The other relies on observable fact. Never trade on a hunch. Only trade on the undeniable confirmed signal. But here is where most traders fail completely. The signal is never merely a single price point. That is a dangerous simplification. The signal is the sustained behavior around a critical level. This is the principle of complete confirmation. Many speculators are defeated because they accept a partial confirmation as the final word. They see the stock touch the high and they assume the move is underway. They do not wait for the market to complete its work. The market must not only reach the desired level, it must hold that level. It must show resilience against the inevitable selling pressure that arises when a resistance point is tested. You must wait for the market to complete its move and hold its position, confirming that the forces driving the move are genuine, sustained, and overwhelming. Think of an army advancing on a fortified position. They do not merely touch the fortress walls and declare victory. They must breach the walls, secure the perimeter, and demonstrate that they have enough occupying force to repel the counterattack. The stock price is the same. When it pierces a significant resistance level, the sellers will naturally appear, those who bought lower and are taking profits and those who are shorting at the perceived high. If the breakthrough is genuine, the buyers will absorb that selling pressure easily. The price will dip, but it will not retreat below the key level. It will consolidate above it, proving that the foundation for the new higher price has been established. That consolidation, that holding action, is the final, essential part of the signal. An early entry preempts this confirmation. It invites volatility to annihilate your position. If you buy the first touch of the resistance, you are sitting right in the middle of the most ferocious battle. You are highly likely to be thrown off by the ensuing chaos regardless of the true direction of the ultimate move. If the stock breaks through $100, do not buy at 108 cents. Wait until it touches $101, pulls back to 150 cents, and then moves decisively toward $102. That action, the breach, the test, the resumed advance, is the confirmation. It is better to miss the first 2 points of a 20-point move than to be shaken out of the entire 20 points because you entered before the confirmation was complete. And this is what separates professionals from amateurs. The market has a malicious tendency to punish the premature entrant by giving them a brief glimpse of profit only to reverse violently enough to trigger a stop, leaving the speculator bruised, frustrated, and out of the position just before the true confirmed move begins. This is why complete confirmation is paramount. It separates a transient fluctuation from a sustained trend. It forces you to rely on facts, not possibilities. Be patient enough to let the market show its true colors. Perhaps the most frustrating experience for a speculator is to be fundamentally right about a major move, yet still lose money because of impatience. High cost of being right too early is measured not just in dollars, but in the catastrophic drain on confidence. If you enter prematurely, you are likely to be shaken out by minor fluctuations while the underlying move is still forming. The market can be frustratingly, deliberately slow. Great movements often take weeks, even months to ripen fully. The initial stages are often characterized by false starts, sideways drift, and sudden deceptive reversals. You, having entered on your early hunch, find yourself waiting. The stock moves 1 point in your favor, then 3 points against you. It lingers, it becomes tedious. You start to doubt your fundamental reasoning, not because the market action contradicts it, but because the lack of immediate progress wears down your certainty. The market does not care that you are fundamentally correct. It cares only about timing. If your timing is off even by a few days, you invite the kind of volatility that forces your liquidation. You exit the position, perhaps taking a minor loss or a meager profit, simply because you cannot bear the prolonged uncertainty. The position was not working yet, and your early entry exposed you to the maximum psychological strain of waiting. Then, inevitably, moments later, the true movement begins. The stock that bored you for 3 weeks suddenly explodes, moving 10 points in 2 days. And you were right, but you were impatient. But here is the devastating part most traders never understand. The market exacts a severe toll for this error. First, you lose capital on the unnecessary stop-out. Second, you miss the profit of the subsequent move. Third, and most damaging, you suffer a profound loss of self-trust. You saw the opportunity, you acted, but your timing was so poor that the correct action resulted in failure. This undermines the very foundation of successful speculation. The market's job in its early stages is to accumulate. It gathers shares from the weak hands and the impatient. If you enter early, you become one of the weak hands. The market must shake you out before it can ascend freely. Waiting for the signal means allowing the accumulation phase to complete. It means allowing the large operators to finish their work, absorbing all the selling interest until the path is clear. When the signal finally arrives, it often coincides with the moment the waiting is over. The stock moves quickly, decisively, and usually without a significant early retracement. If you are determined to enter early, understand that you are volunteering to be shaken out. You are paying the volatility premium. You are sacrificing your emotional reserve. The cost of being right too early is often higher than the cost of being wrong entirely, because being right too early guarantees disappointment and often leads to catastrophic revenge trading later on. Wait for the train to be moving, not just warming the engine. Many speculators view cash as a neutral state, a temporary pause between positions. This is fundamentally incorrect. Cash for the disciplined operator is not a neutral state. Cash is the ultimate strategic position. Waiting is not inactivity. Waiting is intelligent positioning. When you are holding cash, you are holding maximum optionality. You are immune to the minor fluctuations of the tape. You are detached from the emotional demands of an open position. Your mind is clear, and your power to act decisively is at its zenith. Cash provides the critical vantage point necessary for proper market observation. As long as you are invested even slightly, your mind is clouded by hope or fear. You are biased toward defending your current position rather than objectively assessing the true movements of the market. You are no longer watching the tape. You are watching the fate of your own position. But cash demands pure objectivity. You are watching the movements, calculating the odds, and preserving your ammunition. Your capital is your army. You do not send your army into the field until the target is clearly identified, the path of attack is confirmed, and the probability of success is maximized. To throw capital into the market without a clear signal is akin to firing your cannons into the fog. It is a waste of resources and morale, and this is what destroys most trading accounts. The signal is the only license to move cash into the market. Until the market presents a proven high-probability setup, your capital must remain secured, ready to strike, but not exposed to unnecessary risk. Many hold significant capital entirely out of the market for weeks, even months following major movements. People ask, "Are you not missing opportunities?" The response is always the same. There is always opportunity, but the primary job is to protect capital from the low probability opportunities. A speculator's primary concern must be capital preservation, not maximization of daily trading volume. If you preserve your capital, the great opportunities, when they finally arrive, will find you fully prepared to exploit them ruthlessly. Holding cash allows you to capitalize on the panic and the certainty of others. When a crisis hits, the impulsive operators are already fully invested, paralyzed by their losses, and unable to take advantage of the sudden cheapness. They have no strategic reserve. The disciplined operator, sitting on cash, views the panic as a gift. He has the freedom and the resources to enter the market precisely when the risk-reward calculation becomes overwhelmingly favorable. When the signal, though driven by fear, is finally undeniable. Never forget this lesson. Cash is an active position. It is the position of patient power. It ensures objectivity and readiness. Never feel pressured to abandon this strategic position just because the market is fluctuating. Wait for the clear, confirmed, high-probability signal. A fundamental shift in mindset is required to move from the amateur ranks to the professional. The amateur wants to buy at the absolute low and sell at the absolute high. He strives for perfection in every tick. The professional accepts the inherent imperfection of timing. The successful speculator must be willing to pay the premium for certainty. What is this premium? It means accepting that the first few percentage points of a major move will be missed. You must be content to enter the trade after the first volatile shakeout is complete and the direction is undeniable. Those missed points are the price you pay for confirmation. They are the insurance policy against the chaos of premature entry. They are the cost of minimizing risk. But most traders see this as losing. Consider a stock that is due to move from $50 to $100. The impulsive trader tries to buy at $50.08. He risks the entire move because he is buying before the signal is present. He is relying on foresight, not factual confirmation. The disciplined operator waits until the price has moved to, say, $55 and clearly established the line of least resistance. He pays the 5-point premium. He has missed the first 10% of the move. But what has he gained? He has gained certainty. He has reduced the probability of being stopped out prematurely to near zero. He knows that the major forces are now aligned in his favor. He has exchanged 5 points of potential profit for 50 points of high probability movement. The concept of the patience premium is often misunderstood as simply being late. It is not late. It is strategic timing. You trade only when the risk is minimized by the market proving its direction. When the market is uncertain, the risk is at its highest. When the market provides a clear signal, the risk relative to the potential reward drops dramatically. The speculative life is not about maximizing every possible dollar from the market. It is about maximizing the probability of success in every action taken. The amateur believes that if he misses the first 2 points, he has ruined the trade. The professional knows that if the move is genuine, those first 2 points are inconsequential. If the stock is truly moving 50 points, complaining about the first 2 is foolish. It is psychological preparation. You must consciously train yourself to ignore the initial burst of the price. Let the amateurs fight for those volatile early ticks. Let them panic. Let them settle the argument. When the market has resolved its initial conflict and established a clear path, then you enter paying your premium for certainty. This discipline ensures that your focus remains on the larger movement, not the minor fluctuations. Always be willing to pay the patience premium. It is the cheapest insurance in the world of speculation, and this is what professionals understand that amateurs never will. Most speculators focus exclusively on price. They see a price break, a resistance level, and immediately execute the order. They forget the second, equally crucial component of every genuine signal: time. A true signal often requires a significant amount of time to develop. It is not enough that the price touches a high. It must hold that high over a period that establishes credibility. Great movements do not run their course in an hour or a day. They are massive forces requiring significant structural adjustment in the market. This takes time. The impulse trader focuses solely on price. The disciplined operator focuses on the interplay of price and time. If a stock breaks out on a Monday morning, rushes up 5 points, and then falls back 2 points by closing time, that is not a strong signal. That is a transient event. The market moved, but it did not hold. The time element was insufficient to establish conviction. A genuine signal needs time to breathe, to consolidate, and to confirm. How long is enough time? There is no strict rule, but a critical price break that holds through a full day, or better yet, consolidates above the line for several days, carries infinitely more weight than a brief spike that immediately reverses. The time element acts as a psychological filter. It filters out the momentary enthusiasms, the short-lived rumors, and the manipulative thrusts designed solely to create superficial momentum. Only sustained conviction over time proves that the fundamental forces, the major pools of capital, the true shift in public sentiment, the underlying change in value, are driving the price. If the signal has not held long enough to establish credibility, ignore it. It is merely noise on the tape. Think of it as setting concrete. You can pour the cement quickly, but it must be given time to set and cure before you can build a structure upon it. If you rush the building, the structure collapses. But here is what this means for your trading. The speculator who ignores the time element of the signal is building his position upon wet cement. The market uses time to wear down the amateur. If the price moves to $55, stays there for 3 tedious days, and then begins to advance slowly, the amateur becomes bored or fearful and liquidates. He only saw the price move. He did not respect the time the market needed to accumulate and prepare for the true ascent. If you respect the time element, you develop patience beyond the immediate tick. You understand that the market is a colossal machine and large movements require frictional energy and time to build momentum. Wait for the price to prove itself and wait for the position to hold firm. Price confirms direction. Time confirms conviction. Never separate the two. Never under any circumstance anticipate a signal. Wait for its factual, undeniable presence. Anticipation is the act of predicting the future, which is impossible. The speculator's job is not to predict, but to observe and react to what the market is actually doing. Prediction is the realm of fortune tellers and uninformed tipsters. Observation is the realm of the professional. When you anticipate a signal, you are saying, I know what the market will do next. The arrogance of this position is usually punished swiftly. When you wait for the factual signal, you are saying, I will follow the market when it shows me the way. The signal is the market communicating its present status, that the path of least resistance has been established and is now inviting traffic. Early speculators spent years anticipating. They would see a stock falling and assume it must be near the bottom, trying to buy fractions off the absolute low. Fortunes were lost doing this. The lesson learned was that there is no bottom until the market proves there is a bottom. The market, left to its own devices, will always follow the path of least resistance. That path might surprise you. It might defy all your fundamental analysis. But your analysis must be secondary to the tape's confirmation. If you anticipate a break upward, you buy prematurely. If the stock then reverses, you are immediately wrong, exposed, and forced to cut your loss. If you wait for the break upward to confirm itself through a sustained holding action, you are entering the market when the risk is managed. The market has done the hard work of proving the path. Your job is simply to follow the road that has already been paved. The speculative genius lies in patience, not prescience. If you find yourself saying, I think this stock is about to move, stop immediately. Replace that thought with, I will act only when the stock does move and holds. And this discipline separates winners from losers. The signal removes the guesswork. It eliminates the emotional strain of prediction. It provides a clean, objective trigger for action. Do not anticipate a movement because the circumstances seem right. The circumstances only become right when the market, through its actions, validates your thesis. The discipline required here is immense. You will watch hundreds of stocks that appear ready to move, only to see them fail to deliver the signal. The amateur leaps into 20 of them, losing a fraction on each until his capital is depleted. The professional ignores 19 of them, waits for the one clear signal, and executes with full force, knowing his risk is managed by the market's confirmation. Trade the undeniable proven path. Never trade your hopeful anticipation. Impulsive trading is often a direct consequence of a recent loss. This is the revenge trading cycle, and it is the fastest route to ruin. The cycle begins with a legitimate, perhaps large loss. The speculator feels wounded. His judgment is impaired and his primary psychological driver becomes the immediate desire to make up the capital he just lost. This emotional state bypasses the need for a signal entirely. The speculator does not wait for a high-probability setup. He scrambles for any setup, searching the tape for the first stock that shows the slightest movement, rationalizing the trade based on speed and the desperate need for recovery. He trades not because the market is offering an undeniable opportunity, but because his ego demands immediate financial retribution against the market. This is emotional gambling masquerading as speculation. The market is indifferent to your financial health, and it certainly does not care if you feel wronged. The market has no memory, but the speculator driven by revenge operates entirely in the past. The trade executed in a state of revenge is guaranteed to be impulsive, poorly researched, and oversized. The speculator is usually trading against his own established rules, increasing position size to recover the loss faster, or entering positions based on thin signals that he would normally ignore. But here is the trap. The signal is the necessary intervention that breaks this cycle of reckless, emotionally charged retaliation. The hard rule must be established. No action can be taken until the market delivers an undeniable signal, regardless of recent losses. If you have just suffered a loss, your most crucial task is not to trade, but to step back. The emotion of the loss must dissipate entirely. Your mind must return to a state of cold objective assessment. The requirement to wait for the signal forces this crucial delay. If the market is not presenting a high probability opportunity, you simply cannot trade no matter how much you wish to recover the lost capital. If the revenge impulse takes hold, your response must be disciplined. Is the signal confirmed? Has the market shown its hand? If the answer is no, you are compelled to remain sidelined. The speculator who attempts to fight the market to get even will inevitably find the market handing him a heavier beating. Recovery from a loss is achieved through discipline and patient accumulation of profitable trades based on confirmed signals, not through desperate lunges into the next stock that twitches on the tape. Let the emotional wound heal. Wait for the signal. The signal is your shield against yourself. Without it, the market will exploit your psychological weakness relentlessly. This is perhaps the hardest lesson for the professional speculator to master, yet it is the most vital for long-term survival. There will be days, weeks, even months where no reliable signal appears. The market drifts sideways. The price movements are choppy, directionless, and treacherous. The volatility is high, but the conviction is low. The highest form of discipline is the ability to stand aside and do nothing. The desire to trade, the constant craving for action, the feeling that you are wasting time if you are not actively positioned is a powerful force. It is the amateur mindset at its most insidious. Your job is not to trade every day. Your job is not to generate daily income. Your job is to preserve capital and capitalize only on high probability opportunities when the signal is undeniable. If the market is ambiguous, if the price action lacks clarity, if the forces of supply and demand are balanced, your place is on the sidelines. The successful speculator is paid handsomely for patience. He might make the majority of his annual profit during 2 or 3 sustained clear movements, while spending the rest of the year preserving capital and waiting. The amateur attempting to generate steady income trades every day. He loses small fractions repeatedly in the chop, or he is shaken out by false moves. When the great clear movement finally appears, he has depleted his capital, ruined his nerve, and is unable to participate fully. Standing aside is an active decision. It is the decision to ignore the noise and conserve your resources. This rule demands incredible humility. It means admitting often for long periods that you do not know what the market is doing, and therefore you will not risk capital on guesswork. The impulsive trader fears missing the movement. The disciplined operator fears unnecessary loss of capital. If the tape does not speak clearly, do not interrupt its silence with your trades. The market provides signals for movement. If it fails to provide those signals, it is issuing a warning. Stand aside. Heed that warning. Countless days can be spent simply watching the tape, doing nothing, yet fully engaged. Learning. Observing the behavior of prices under various conditions. That observation without the distortion of an open position is immensely profitable in the long run. Never force a trade. If the signal is absent, stand aside. It is the ultimate test of discipline over desire. Capital preserved in the doldrums is capital ready for the hurricane of opportunity. Your success in the market hinges on one fundamental truth. Impatience is the tax levied on the amateur. You must refuse to pay this cost, or you will forever pay it with your capital. You are not an amateur from this moment forward. You are a disciplined architect of opportunity. You are an observer of facts. You are a follower of the line of least resistance. You wait for the proven signal, or you do nothing at all. You accept the patient's premium. You ignore the hunch. You secure your cash as a strategic reserve. You reject the impulse to recover losses immediately. You will allow the market to prove its direction, holding its ground in both price and time before you commit a single dollar. Discipline is the only currency the market truly accepts. Master the weight. And you master the weight, and you master speculation itself.